Ladies and gentlemen.
Welcome to the Blockcrunch podcast, the go-to podcast for investors and builders in crypto. And before we get started, just a reminder for you guys out there, the Blockcrunch podcast is intended for informational purposes only. Neither the host nor its guests are licensed financial advisors, and nothing discussed should be construed as financial advice. Views held by Blockcrunch's guests are their own, and sponsorship messages do not constitute financial advice or endorsement. With that out of the way, let's jump right in. Today's episode of the Blockcrunch podcast is brought to you by Protocol Labs, the team behind Filecoin. So to tell us a little bit more is Colin Efren, who leads ecosystem at Protocol Labs. So Colin, can you tell us what's one thing that people misunderstand about Filecoin the most?
One thing people don't realize is that the launch of smart contracts on Filecoin in Q1 of this year will transform the Filecoin network into the world's largest open data economy and a full-fledged layer one within Web3. Most people think of Filecoin as the world's largest decentralized storage network. And while that's true, the community onboarded 450 petabytes of real data in 2022, up 18 times from the beginning of last year. Q1 of this year is transformational. The community is launching the Filecoin virtual machine where users can start writing programs to automate storage and renewal of data, pay for computation, and trigger retrievals. All of which is built on a permissionless market of hardware providers that is 15 exabytes in size. This will open the world's largest data economy and make Filecoin one of the most powerful layer one blockchains in Web3.
Hello there. Now, before we move on, I'd love to thank the hundreds of you who have subscribed to Blockcrunch VIP, because with your support, I've been able to share my real thoughts on specific projects that I don't usually share on interviews in a format that I enjoy more, which is bi-weekly written posts. We've also been able to offer exclusive AMAs, sharing my investment frameworks, interactable models, and breaking down important trends before they become big. Now, we even had Elon Musk comment on one of our threads recently. So if you haven't already, head on over to theblockcrunch.com/VIP, and you can access dozens of hours of research for what you'd spend on a coffee a day. Hey everybody, welcome back to another episode of the Blockcrunch podcast. Now, this past month has been one of the wildest times for banks since 2008. The genesis of Bitcoin was born in the wake of the housing crisis, and now with the largest crypto-friendly banks, Silvergate, Silicon Valley Bank, and Signature going under, and with Credit Suisse, which is a 170-year-old bank on the verge of being subsumed by their major competitor, it almost seems like a replay of 2008. Now, on the back of this, we have a high-profile entrepreneur and former CTO of Coinbase, Balajis, making a surprising and bold and very public call for Bitcoin to hit $1 million in 3 months, and for USD to enter hyperinflation as the direct result of liquidity being injected into the economy by multiple central banks. Now, so with all this drama, I wanted to talk to someone who can help us separate signal from noise, which is what this show has always been about. And there are fewer people better than Ram Ahluwalia. And Ram is the CEO and co-founder of Lumida, an independent investment advisor specializing in digital assets. Now, previously, Ram was also the head of crypto at Cross River, one of the few, dare I say, remaining banks that still has a very heavy focus on crypto support, after selling his company, Peer IQ, which focused on credit risk and analysis. Now, before that, Ram was a vice president at Merrill Lynch. So there are really fewer people in this space that can really speak to this with credibility. So I'm really, really excited to have Ram on the show to help us break down the events that are taking place in the banking world, the government's response globally, and in the final part of the interview, we're going to talk about how this all ties into crypto. So make sure you stick until the end. Now, welcome to the show, Ram. I'm really, really excited for this.
Thanks for having me, Jason. I'm a big fan of your podcast. Thanks for all the work you do week in and week out. I've been following you for a long time, and I'm excited to dig in.
No, definitely appreciate that, man. Now, let's start with the recent events that's dominating headlines everywhere. Now, a few banks just went under recently, and can you just walk us through what are the commonalities between them? Because, Silvergate, Silicon Valley Bank, and now Signature, just back to back. What is going on?
Sure. So if you take a step back, these banks have a couple properties in common. One is they had a high level of uninsured deposits. And the reason for that is that these are commercial banks. So Silvergate serviced the crypto industry, SVB serviced Silicon Valley and the tech category, and Signature also is a commercial bank. And the reason why that matters is that FDIC insurance covers up to $250,000. That's sufficient for retail, but commercial deposits are often well in excess of that. So that's the first feature that they have in common. The second is that there are unique circumstances around the business models of these particular banks. And third, the risks that the banks took on. SVB had record inflows of deposits in Q4 21, coinciding with peak crypto, peak venture. And they deployed that, which is really an egregious decision, in long-term treasuries and long-term mortgage-backed securities. They really were an outlier if you compare them to other banks. And there are a number of management deficiencies around SVB, including their usage of hedges, which it looks like they used to monetize. They sold the hedges on interest rates last year at this time, and they booked a P&L gain and talked about, and they boasted around that. And then, the other factor at work here is that, SVB had experienced a 50% decline in their demand deposits. So again, a demand deposit you can withdraw whenever you want. That happened last year, not this year. So there's been this slow motion bank run underway. And the reason why SVB was exposed to that is because their customers are cash burning startups. So they've taken a lot of deposits. Their startups spend the money. And of course, that deposit inflows are limited because you also saw a decline in venture funding by about 60 to 80%. SVP was kind of naked on the beach as the tide's going out, and they had management deficiencies around it. Silvergate, it was really more of a crisis of confidence. So their customers pulled back. Silvergate honored every single depositor claim. They managed it well, from the point of view of having sufficient liquidity coverage. There was no need for any regulatory intervention. I believe that Silvergate is an unfortunate story of how social media amplified fear, uncertainty, and doubt. If you don't have any customers where you're paying out a lot of money on CDs, you're not profitable. They had to liquidate. Signature Bank last year also experienced a slow-moving bank run, about a 20% year-over-year decline in deposits, not 50% like SVB. We need to learn a lot more what happened. Senator Barney Frank is on the board of Signature Bank. Barney Frank co-authored Dodd-Frank, which is the most historic piece of bank regulation, in decades. His interpretation is that it was crypto-driven. I would say we should pause before rushing to judgment. My sense is that, Barney Frank, as a senator and as a board member, in his capacity as a board member, he's liable for any negligence in management or a failure of oversight. So my sense is he might just be pointing the direction in another way. And there's also come to light reporting around deficiencies around audit, credit risk issues, AML issues. The other thing I'd point out is that it's the New York State DFS that put Signature Bank into receivership. New York State DFS is the primary regulator for Signature, not the Federal Reserve or the FDIC or the OCC, which is the national bank. That's an important distinction to make. And I know we'll come back to this later, but I do believe New York State DFS has a more aggressive posture towards crypto. I'm not sure that that's the case with all the other bank regulators. So that's a quick summary of the bank issues. We can go down a couple rabbit holes if you want, Jason. I'll let you direct it.
Yeah, and I think that point about Barney Frank is really, really interesting because he was public that he's been skeptical of crypto. He's not a crypto bull. He doesn't have, a lot of vested interest in the space, but he still made this comment that he thinks that this crackdown on bank is crypto driven. And this kind of led to a whole quote unquote conspiracy on Twitter. I think mostly championed by Nick Carter from Castle Island Ventures, who coined this kind of choke point 2.0. I guess it seems like you don't think it's actually a focused attempt from regulators to crack down on crypto, and the remaining.
I think it's mixed. I think the honest answer, it's mixed. I'm probably in choke point 1.5 or 1.7 camp. It's not 2.0. It's not choke point. And regulators had different points of view. Again, Barney Frank is liable as a board member. It's very convenient to point to crypto and get the narrative off of why he may have been asleep at the switch, because boards have a responsibility for oversight. There's this terrific article in the Financial Times that was published several months ago that hasn't really received much attention. And it concerns DM. Now, DM, for your audience, just briefly, DM was a stablecoin that was going to be introduced by the DM Association. Facebook would be a distribution partner, as well as Uber, Lyft, Amazon. So you'd have hundreds of millions, if not potentially billions of consumers using a privately issued stablecoin, not ETH, but still step in the right direction, to move money around using your cell phone. And Silvergate would have been the issuer of that. And what the FT reporting indicates is that Fed Chair Powell was supportive of the program. However, Secretary Janet Yellen at the 11th hour said she couldn't support him in that decision. And that decision changed the course of crypto history. Imagine if we were moving money digitally in the same way that WeChat does that in China, or in the same way that in India, people don't use cash anymore. Even rickshaw drivers don't use cash anymore. So what that means is that regulators have mixed views on crypto. Obviously, we know where the SEC stands around that. We have a view of what the CFTC stands. But the Treasury Secretary doesn't appear to be a big fan of crypto. Whereas the prior Treasury Secretary, Larry Summers, he was on the board of Digital Currency Group. And maybe you would have a different outcome. He's also a Democrat if you had a different person in that seat. So, the U.S. is behind on crypto clarity, crypto regulation. And I think Ryan Selkis, the CEO of Messari, is right. Now is the time to focus on a responsible crypto policy framework.
And I think there's an element of maybe fear mongering on Twitter where people are saying that, wow, crypto is completely unbanked in the US. American-based entrepreneurs are screwed if they want to do Web3. But at the same time, there are banks like Cross River, which you're very, very familiar with, but also a long tail of maybe a dozen or so banks that seem to be rising to prominence and supporting crypto now. Is your view that these banks are probably not under the same risk? Assuming that they're running solvent businesses, they're probably not targets of regulators with a anti-crypto agenda.
Yeah, I'll answer it this way. So first off, the banks are well capitalized. They've got plenty of deposits, and it helps that these other banks like Cross River are privately held, because to the earlier point, one of the other lessons we're learning is that we're seeing the first bank runs in the internet era, and Silvergate and SVB were banks born of the internet. SVB is a venture.com tech bank. Silvergate's a crypto bank. They both are run on internet customers, right? So, but they're destroyed via social media and the convenience at which you can have a bank run done digitally, as opposed to depositors lining around the block, which is what happened in the last bank run in the UK with Northern Rock Bank in 2008. Now, the regulators are scrutinizing crypto. They have. Ever since Silk Road, the regulators were focused on crypto. FinCEN came out with guidance in 2013. Homeland Security departments been focused on crypto. I talked to a friend who is a private client of a mega money center bank. In the last 12 months, before FTX, he was canceled because he disclosed he had crypto holding. That's a very conservative, large mega center bank. And that's their policy. That's not regulatory driven. That's management policy, board policy driven. I can tell you, especially given my time with Cross River, and I faced off with the FDIC, and the FDIC incidentally was a customer of PureIQ software. So I know the FDIC decently well. They are very focused on crypto. They have a mixed approach, a nuanced approach. They want to ensure safety and soundness of the banking system. That's the number one principle at the top of the masthead. You're going to see that in all these press releases. You saw that in the press release 2 Sundays ago when there was the intervention from the bank regulators to protect uninsured depositors, safety and soundness. That's the number one, goal. They do want to encourage responsible innovation, but the standard for a bank to engage with crypto is extremely high. So if you're a bank and you don't have the technical chops, you're not going to be permitted to engage with crypto. Now, the Federal Reserve updated the Federal Registry, and the Federal Registry contains all the rules and regulations that people must abide by. And it's interesting. What they state there is that, in their view, they do not believe that banks can interact with the blockchain in a manner that is consistent with, quote, safety and soundness. So that is more indicative of Nick's thesis, but it's not closing the door. It's not saying that you can't bank crypto customers. And it's not saying that there isn't some other method that one could use to interact with the blockchain in a safe and sound manner through other technology, procedures, controls, or further education with the regulator. That said, I do not expect you're going to see a crypto bank charter for the foreseeable future. Regulators are in risk off mode. Even banks and boards are in risk off mode. They're not trying to lean in. They're trying to protect their depositor base and distance themselves from crypto. You saw even Signature Bank, before they had their bank run, indicated they want to cap deposits around crypto at 20%. So, that's what's unfolding. You're going to hear more hearings, more investigations, Freedom of Information Act inquiry to help us really get to the bottom of how much of this was deliberate crypto targeting versus other drivers.
Yeah, and I think your point about this being the first kind of digital bank run is so important as well, especially because it happened so recently with the FTX event, where I think a lot of people were pattern matching that blindly to these banks, which caused a lot of the panic. But I'd love to kind of move on to how the world is responding to these bank runs, like the global responses from the central banks. So let's start with the US first. So the US Fed launched something called a Bank Term Funding Program, which some have compared to QE, which, as we all know, was a large driving force behind the crypto bull market during COVID in 2020 and many risk assets. So can we expect a similar effect, or is there anything fundamentally different from how actual QE impacts long duration risk assets than this BTFP?
Yes, there's a. Let me walk you through the BTFR, and let me step back for one moment to talk about the policy response. This will give you an insight into what the regulator playbook is. The regulator playbook has two imperatives. One is to stop the bank runs. And the second imperative is to create liquidity to banks. The basic idea that the regulators have is if these banks can hold these high quality liquid assets, namely treasuries and mortgage-backed securities, to maturity, then the bonds are money good and the banks will survive. However, if the banks have a bank run, then they're forced to sell these high quality liquid assets, even though they had a significant drop in value over the last 12 months. And that creates an impairment to book equity. And that's, of course, what led to the destruction of Silvergate. They had high quality liquid assets, very high liquidity coverage ratios, and were done in by a customer run of the bank. So that's the way to think about what the regulators are doing. So step one, how do you stop bank runs? Well, you protect uninsured depositors. And that's what they announced 2 Sunday evenings ago with respect to SVB and other banks as well, including Signature. They're going to keep doing that. And the Treasury Department today, was reported by Bloomberg, is assessing whether they have emergency authority in the FDIC to provide broader, more sweeping uninsured deposit coverage. And the second step that they have to do is liquefy bank balance sheets. What that means is, the banks have loans. The loans are illiquid. They're not marketable securities like treasuries or mortgage-backed securities. And the banks are in the business of creating loans, not necessarily in investing in securities. So if you can create liquidity and you stop bank runs, you save the banks. And the BTFR program is a tactic under that second imperative, create liquidity for the banks. So here's how it works. And here's the connection, similarities and differences to QE. The way it works is banks can pledge eligible collateral. Those are those high quality liquid assets to the Bank Term Funding Program. And they can receive up to the market value, up to 100% of the market value of those securities. Okay, so it creates liquidity. Now, is it another form of QE? Does it expand the Federal Reserve balance sheet? Yes. Here are the differences, though, and there's some nuance here. When the Federal Reserve is engaging in QE, the Federal Reserve is buying bonds on the open market, and they're taking those treasuries and mortgage-backed securities off the market. So they're reducing the supply outstanding of those securities, and they're replacing it with cash. That's monetization. And that led to ultra low interest rates and spread tightening, and it was really irresponsible policy. We're paying the consequences of that now. Okay. This is different. This is financing an asset. So here the Federal Reserve is saying, hey, bank, you have assets that are money good if you can hold to maturity. I'm going to liquefy that. If you pledge that to me, I'm going to give you an advance on that. And now then the bank has liquidity to honor withdrawals. The key question is, will the banks create credit with that liquidity? The answer is no. Why? Because the liquidity is running out the door to these depositors that are scared. And the banks will conserve that liquidity to ensure that they can survive and don't have their equity wiped out. So here's another way to think about this. Let's think about like the mortgage finance market and houses in general. Before there were mortgages, you'd have to buy a house fully paid in cash, right? A house in around the New York City area is like $1 million. So without a mortgage, you'd have to save $1 million and then go buy a house. That's very expensive. The supply of houses hasn't changed though. When you introduce mortgages, what happens though is the demand for mortgages increases because the economic decision changes from, do I shell out $1 million to buy a house, to a different decision, which is, can I pay $3,000 on a monthly mortgage, even if I don't have the cash? And that means the demand for houses increase because more transactions happen, because you can afford to finance it through mortgages. Now, does mortgage financing increase the value of homes? The answer is yes. Without mortgages, houses would not be worth as much because there'd be less willingness to purchase homes because there's a budget constraint. And that budget constraint is relieved through housing. So that's the nuanced, proper way to think about the relationship between financing of an asset and what the market clearing price for that asset is. But fundamentally today, because those banks won't go turn around and create new loans, that immediate consequence won't be inflationary. There's a good question around, well, what happens a year or 2 years from now with that excess liquidity? Does it get unwound? So I'll pause there.
No, I think that's an incredibly clear explanation of what has happened, because I think a lot of crypto native traders, they kind of look at Fed's balance sheet, they see the line going up, they think, wow, this is QE part two, we're going to get another crypto bull market. But from what you explained, this money is not converting into the quote unquote real economy through loans. And this is a slightly different type of finance.
Yes. And here's several data points to look at to really understand what the credit creation is happening. Go to the St. Louis Federal Reserve database called FRED. Look at the Fed Home Loan Officer Survey, and you can see credit conditions are tightening. They have been tightening. They're going to continue to tighten, even more now. The second thing is you want to look at financial conditions. There's good reporting around easiness of money access. And the third, and this is really critical, the commercial banks. What are the commercial banks doing? Now, the top 5 banks in the United States have over half of the deposits, even though there's 4,000 banks in the land. There's tremendous deposit concentration. So that's where you want to look at credit creation. Is it happening there? And the answer is no, they're tightening. You can look at their 10Qs or 10Ks and look at the securitization markets. The securitization markets have slowed down, right? In the same way that you have an IPO, an equity IPO is an initial public offering when you take these private securities, list them to public market. The same thing happens in debt capital markets. And that what you call a debt capital offering, you don't call it an IPO, you call it a securitization. And there's public data you can find. Go to like Moody's, go to the ratings agencies, go to finsight.com, go to S&P, and you can see that the pace of debt securitization has slowed down dramatically. That means you're not seeing much credit creation. The other thing is I did some channel checks. I called some friends at the commercial banks, the investment banks. There's a credit freeze going on. That's the new theme you're going to see. My hedge fund buddies, they're concerned about a credit freeze, and it takes time for that to be manifest and felt. It means fewer deals that get done, and that means less credit creation. More probability of dislocation, right? We're now seeing the lagged effects of the fastest pace of Fed rate hikes since 1981. Now things are starting to go bump in the night. It takes time. And the players, it's not systemic yet. The players that are having issues are those that had significant asset liability mismatches or were over concentrated to commercial depositors and didn't have a diversified business model.
That makes a lot of sense. And I really want to double click on that because in a recent interview that you did, I think you mentioned that the Fed is currently losing around $2.3 billion per week, which increases to $2.6 billion with more rate hikes. So I think the number you gave was over 1 year. This is about 130 billion. So how does that impact the Fed's ability to continue with this course of action? And what is your outlook there?
Yeah, this is mind-blowing stuff, right? By the way, I did that thread the day SVB blew up because really I was trying to highlight that is that, one, these are known issues by the regulators. The Federal Reserve has been talking about the hold to maturity issues around bank balance sheets. And if you look at the dollar value of the regional banks and how much they're underwater in the community banks, it's somewhere between $500, $600 billion, depending on where the 10-year bond is at. Because when bond prices tighten, the value of those bonds go up, right? But the Federal Reserve, if you mark to market their own purchasing of treasuries and MBS, it's around a $1.5 trillion. It's 3 times the size of the banking system. Here's the difference, though. You can't get a run on the bank at the Federal Reserve. What you can do is you can exit USD and go to Bitcoin. That's what Balajis is doing. That's the best thing you can do. You cannot bank run the Federal Reserve because they can print money. So I have a tweet thread that describes this in detail. By the way, Barron's reported on this over the weekend. They didn't cite my research, unfortunately, but in case, I had some people saying, this is like Fed quackery. It's not the case. This is using public data from the Federal Reserve. And the other thing I'll point out is the Fed themselves, there's a footnote that I linked to in this thread. They lay out the issues. And then at the end, they say, this does not interfere with our ability to conduct monetary policy. So they know people are going to ask these questions. So the Fed can hold those bonds to maturity. You're correct. They are losing about $2.3 billion per month. And therefore, they're no longer remitting excess returns to the Treasury. And the Federal Reserve's capital is around $40 billion. The Federal Reserve has a balance sheet, and that balance sheet has about $40 billion in capital. So if you take 52 weeks times $2.3 billion, you can see that you're going to blow through that capital within a year to the order of 2 times that. And then if Fed rates stay higher for longer, even more. And by the way, another interesting fact is the break-even rate for this is 3%, meaning if Fed fund rates are higher than 3%, the Fed loses money. If it's below 3%, they make money. And the simplest way to understand that is that the Fed has about $8.5 billion in these treasuries, mortgage-backed securities that it earns interest on, but it pays out interest on the $5.7 billion in liabilities it has. And those liabilities are to member banks that have reserves at the bank that the Federal Reserve pays out to, and that's floating rate exposure. So when rates go higher, they're paying out more than that $5.7 billion, and they take in on that $8.5 billion portfolio. And that is the reason we have these issues. And, the Federal Reserve has a clever accounting trick where, the more they lose money, they accrue what's called a negative liability. They also call it a deferred asset. They call it a deferred asset because they're not required to remit funds to the Treasury until the Federal Reserve is made whole on that. So the Federal Reserve cannot be put into Chapter 11 on that obligation. So it's I encourage you all to check out the thread. It's really interesting. It has potentially inflationary consequences, though, because the Federal Reserve is losing money. They have to create money to finance their own operations to the tune of about $100 billion a year. So, you can do the math on the inflationary impact. It's not a big number in terms of the percentage, but it is a number, yes. And though, the creation of that liquidity by the Federal Reserve must be unwound to stop an inflationary effect. That's the key thing. In the same way we talked about earlier, Jason, with the BTFR programs, right? Let's say the banks heal. Let's say the bank run stop. And let's say the banks still have this excess liquidity and they go create new loans. That is creating credit. That creates more money, chasing a fixed supply of goods and services, and that would be inflationary. Same question for the Federal Reserve. They intend to unwind that. We have to see. That's where the macro and the trader people should focus on those metrics.
And this seems to be one of the kind of fundamental pillars behind Balajis' call for hyper-Bitcoinization, which is like getting out of the Federal Reserve, getting out of the USD system. So obviously, I think his target is meant to be a bit bombastic and attention-grabbing. But I'm curious, like, any general thoughts there about his call for $1 million Bitcoin in 3 months?
I think it's completely off base. It's not going to happen. I laid out a vision of the world where you have Bitcoin going to $1 million. That implies what? That's a 50x in 90 days. That's a 5,000% inflation rate. in 90 days. Annualized, that's a 20,000% inflation rate. By the way, a 5,000% inflation rate is well in excess of Zimbabwe. Okay. Zimbabwe is not a great place. I've actually been to Zimbabwe and I've been to Zambia because I'm very interested in inflation and currency. Do you know the scene in Indecent Proposal?
No.
Where I know there's a scene in Indecent Proposal, a funny story for your users here. But this couple and they agree to, taking $1 million. $1 million used to be worth something in the 90s. They take the $1 million from someone for this indecent proposal, and there's a scene where they just kind of throw it around like the bedroom because they're like, they're rich. I got $1 million. In Zimbabwe, you get $1 million for like $10. When I came home to my team and staff in Merrill Lynch, I started handing out like hundreds of thousands of dollars in Zimbabwean currency to people there. What's the point, though? Let's get back to your question. So, no, look, if that world happened, it'd be a very dystopian future. The unit of account would not be US dollars, gold, or Bitcoin. It'd be things like bullets. Maybe, in Russia, the unit of account was like cigarettes and vodka. And it's not a pretty picture. I don't think that's going to happen at all. Not nearly, close to that. So there.
Yeah, I think a lot of the crypto folks cheering on for $1 billion Bitcoin. I don't think they'll be cheering if that does happen within 90 days. I love.
It's an ugly picture for society, and even if you had a ton of Bitcoin exposure, the social unrest and the disruption would change. You remember in 1934, FDR outlawed even the possession of gold. It was illegal to hold gold in your safe deposit box. And they also stopped the convertibility of fiat into gold. So here's this irony, right? So supposing Bitcoin gets to that level, what would the US do? The US would say, okay, yeah, let's consider stopping the convertibility. Let's make Bitcoin holding illegal. Now, non-custodially, you could hold it, but the exchanges, they would seize that. And then if the US dollar really did depreciate that much, they would use gold and Bitcoin to finance the purchase of imports like oil and other assets. So, and then how would you settle if you don't have Coinbase to intermediate transactions? Because if I'm going to pay Jason some fee for a service, I've got to deliver you the Bitcoin. How do I ensure you deliver me what you promised to deliver me? There's no decentralized exchange to ensure we can do a simultaneous non-intermediated transaction. Where we are today with the current state of technology, you still have to rely on trusted intermediaries like Coinbase to guarantee settlement.
Yeah, no, I think that it's not a world that we want to see today. But I'd love to kind of take this time to jump over to the other side of the Atlantic and talk a little bit about Credit Suisse because something quite big's happening there as of the time that we're recording right now. They have been having some issues with massive outflows as early as last year already. I think the government recently approved a pretty controversial deal from UBS to save the bank, but by wiping out bondholders and not shareholders. So that means, all the time I spent in Finance 101 was basically wasted. Now, before we dive into the implications, can you just brief our listeners on what actually happened there?
Yeah, I'll summarize it for you. So, CS, as you pointed out earlier, historic institution, 165-year-old institution, one of the top two investment banks and wealth management houses in Switzerland, over $1 trillion in assets. And, CS has had a lot of issues post-crisis. They lost a bunch of money on financing Archegos, a hedge fund, which blew up. Two, they've had a significant amount of compliance concerns, AML, KYC concerns, and a significant amount of litigation and fine risk. CS stock's been trading around at $3 as early as October of last year. These are known issues. In fact, the stock price of UBS has been going up over the last 10 years, while CS was flat, then going down, right? So what happened is last week, their largest equity shareholder, which is Saudi Arabia, which owned about 10%. By the way, the second largest shareholder was the Qatari Investment Authority. They said they do not want to invest more in Credit Suisse, and that caused a collapse of confidence, and it accelerated a bank run. And then what happened on Saturday is UBS entered into an agreement to buy Credit Suisse for about $3 billion in change. It's nothing, right? SoFi, which is a fintech that's not even profitable, is worth more than Credit Suisse, which has, again, trillion plus in assets. And it's controversial, to your point, Jason, because equity shareholders were not wiped out, but the kind of COCO bonds, alternative tier one, subordinated debt, those are old terms. I mean the same thing, by the way, was wiped out. And the Swiss government announced that they're going to pass a law to retroactively make illegal. So lots of rule of law questions and considerations around this, in addition to, the prioritization of payments in the capital stack, which, as you pointed out, is kind of finance 101. So it's very controversial. What are the consequences? Well, the UBS is now the world's largest global wealth manager. Second, they are far and away the leading universal bank in Switzerland. So you have this concept of the GSIB banks, or systematically important financial institutions, the SIFIs. My view is that UBS is at a level above even that, because it's hard to imagine that the Swiss government would, through some unforeseen set of circumstances, would find a way to zero out or put into receivership the largest bank in all of Switzerland, which is now their pride and joy globally, right? The Swiss take pride in their banking system, and UBS now is the pride and joy for the world, for the Swiss economy, and Rolex watches, and I guess some nice chocolate and fondue.
Yeah, and I think one of the very interesting developments that maybe not so interesting to people who are in finance, but the one thing that caught the attention of the crypto native folks is this announcement of boosting liquidity to swap lines. So basically, multiple central banks around the world have this arrangement called a swap line. For our listeners out there, for central banks to basically exchange currencies. And what I thought was interesting was Arthur Hayes, the co-founder of BitMEX and currently, I think, independent investor. He described a following chain of events, which I'll attempt to summarize for our listeners here. So basically, he said that the Fed will open swap lines to, say, the European Central Bank. The ECB can then give that money to local struggling banks, and in return, those local banks pledge U.S. Treasuries to the ECB at par so that they don't have to dump it in the market. So this allows the Fed to basically prevent US Treasuries from being dumped and for local banks globally to effectively be bailed out. Now, the end result, he said, is all these treasuries held in the entire developed country banking system will be allowed to be lent against, which leads to massive liquidity similar to QE. I'm curious about what you think about this line of reasoning, because it seems like all things lead to the same conclusion, which is this is QE, Bitcoin's going to go up.
Yeah, no, that's not QE. The BTFR we talked about that already, but it's somewhat indicia of QE to the extent it creates, the loans, but this is not. So these swap lines were also introduced in 2008, and primarily what they're doing is testing the system. The world economy is still largely dollarized. Trade is still dollarized. You still have even emerging markets like El Salvador, which adopted Bitcoin, is still a dollarized economy. You have emerging market debt that's denominated in US dollar terms. And when you have a risk-on scenario, there's a flight to safety. There's a flight to treasuries and 10-year bonds, but also a flight to US dollars. And so dollars become very scarce, and there's a risk that mistakes can happen. If there's a dollar shortage and you're not able to honor your dollar obligation, then an institution that otherwise might be able to meet its obligations is unable to do so. So what they're looking to do is grease the wheels with these dollar swap lines. As you pointed out, the liquidity is against treasuries. They're fully collateralized, and I don't think the primary motivation isn't to prevent treasuries from dumping. That's not it. The primary motivation is to create liquidity, in this case, for other central banks. The central banks, in turn, can then create liquidity for their own banks. This is it's a preemptive, proactive kind of maneuver. That's really what this is. They're doing like a fire drill. They're trying to get ahead of things where they can. I don't view that as inflationary.
Yeah, and I think that's a good way to kind of segue into the last part of the discussion, which is, how does this all tie back into crypto? Because obviously there's a lot of speculation before that this BTFR might be inflationary and beneficial to crypto, which I think we've kind of discussed the nuances there. And then, most recently there were talks that maybe these swap lines will add liquidity to the markets and be inflationary, which we've addressed as well. So all in all, it doesn't seem like there is a lot of, inflationary forces on Bitcoin, but at the same time, we've seen Bitcoin basically almost perform as if it was gold and basically outperform a lot of other assets in the past week. So what was happening there? Is this kind of just being...
Yeah, like Bitcoin's had an extraordinary run this year. I think up
Yeah.
40%. Going from peak the year post FTX to where we are now. I'd say a few things. One is my working framework is that Bitcoin is a hedge against negative real rates. What's a real rate? It's inflation less it's the real return on currency. That's the simplest way to look at what a real rate is. So you've got to deduct the inflation rate from the nominal return, and then you get to your real rate. So when real rates were negative, that was an ideal time for Bitcoin to thrive. And of course, we had that with 14 years of ultra low interest rates and quantitative easing. Now we're moving into a positive real rate regime. Okay. So Fed funds are now expected to go lower in Q4. There's a Fed pivot that's repriced back into markets. And I believe that is a driver for why Bitcoin has increased in price, because that would be moving the US into a negative real rate regime. That's one. The second is narratives are powerful, as you know, in crypto. And the narrative of a QE move is a powerful narrative, and the Bitcoin liquidity is less than what it has been, say, 1 to 2 years ago. So that can have an impact, as well. I think the third is I still think it's worthwhile to think about Bitcoin and digital assets as pricing like a risk asset, like a long duration risk asset. So if you want a view on Bitcoin, you should have a view on the price of Coinbase. Coinbase has a 90% correlation to Bitcoin, certainly did last year. But there are also other cross-cutting effects. And Bitcoin is increasingly trading as inverse relationship to the US dollar. So again, there's more nuance. There's Bitcoin and there's everything else. Like Bitcoin, I'm starting to see global macro hedge funds trade it like a currency. So there are some cross-cutting effects around Bitcoin, but I think it shares price drivers with the other digital assets around the outlook for Fed funds and real rates and risk on, risk off. But it also benefits when the US dollar declines in value.
And can you explain a little bit about your reasoning about Bitcoin being seen as a hedge against nominal real rate? Like from the perspective of an investor, if I see nominal real rates being negative, what is my thought process? How does that lead me to Bitcoin?
So if the nominal rate is positive, but the inflation's higher than the nominal rate, you got a negative real rate then, right? And this is an empirical observation of the performance of Bitcoin. That's one. And then you start to say, is there a theoretical basis for that? And it seems like there is a good intuition for that. And the intuition goes for all the arguments that a Bitcoin holder would have. You've got a fixed supply of an asset, and then you've got a devaluation of other currencies that asset is priced in relation to. And then that would increase the value of that asset. That's the argument. That's the reasoning. It's very simple. There's a good intuition behind it. That's it. I think that's a reasonable way to think about how to price Bitcoin. So in other words, if the Fed wants to crush inflation, and that means they want high real rates, that would argue for a lower price of Bitcoin and a lower price for long duration assets, because long duration assets are punished in a high real rate environment because higher discount rates mean the present value of those assets are much lower, right? And a higher real rate would strengthen the value of the US dollar, which would create pressure for Bitcoin. So on the other hand, though, as you know, it's really been fun. It's really quite interesting just to see some of the decoupling trading, right? Where you've seen Bitcoin rally over the last weekend, and I think some of that was flight to safety, technical trading in response to the USDC breaking the buck. In fact, there was a flight to safety to Bitcoin from USDC. Look, I think those are really interesting things to keep watching, whether this decoupling happens. I hope there's a decoupling. I don't expect there will be a decoupling, though. I hope there's a decoupling because we all benefit from diversification. And, Bitcoin has a noble purpose in censorship resistant and enabling movement of money across border efficiently, frictionlessly. That's an incredible story, right? If you're in Venezuela or Zimbabwe or Iran, and your freedom of movement and transaction is controlled by a despotic regime, Bitcoin represents human freedom, and I believe in that. But I don't think we're at the tipping point moment. Balaji believes we've gone from gradual to a sudden moment, and there's this new regime that's about to take hold. I don't think that's the case.
And I think just to close this out, I'm curious. So now I think we have a pretty clear explanation of how all these things tie to Bitcoin. But what about the rest of the crypto market? Because it seems like there should be a different argument made for Bitcoin's thesis and the rest of the DeFi stuff, NFT stuff, gaming stuff.
It's a great question. And Jason, I love your points of view on this as well. We had a dinner a few weeks ago with a couple others, and I learned as much from you as I do from others. So I'd love to hear your take on it. But I think in terms of thesis, infrastructure investing makes a ton of sense. So if the category needs, like, why did Genesis exist? Why was there a need for a prime broker like Genesis? Why wasn't DeFi sufficient? DeFi is not institutional grade yet. You need APIs, you need broader token coverage, you need the ability to finance at different kinds of maturities. You need to tie it to the UCC bankruptcy filing framework. There's a lot more you need there. So infrastructure. But to your point, which you raised over the dinner, I think you're right on the mark. Infrastructure is a very crowded thesis. So you pave through the nose on infrastructure investments. I think some of the better moves in crypto, honestly, they're not even buying the public tokens. And we all know, like, the VCs did very well through their token offerings. There's obviously going to be a lot more scrutiny around that from the SEC, around the concerns around VCs dumping on retail, quote unquote, right? But the VCs have structural advantages. Retail investors can't legally participate in ICO in the United States. There are also rules and regulations. You got to be qualified purchaser, accredited investor, but the VCs can do that, and the VCs benefit from that. So I think there's smarter ways to play into crypto. And obviously we focus on this from a private wealth advisory, focused on digital assets and alts. But here are some examples. One is we're looking at a private equity fund that's going through the bankruptcy dockets of Bitcoin miners that are selling Bitcoin mining equipment that last year was worth 100 cents on the dollar. Now it's worth 10 cents on the dollar. And you can do the math on what the hash rate is, what the cost of electricity is, what the value of Bitcoin is, what the cost of hedging that is. And essentially it's a cheaper way to back into the price of Bitcoin. I think other early stage venture investments are a great move, but you got to find VCs that are valuation sensitive, that have a thesis based approach, ideally have an operator background, can source deals, compete and win deals. And there's less capital in crypto now, which is great because it means you're going to get higher quality founding team. You're also going to get less capital chasing deals. Less capital chasing deals means better valuations and less competition. So I think the vintage for crypto investing now is going to be good. I think the vintage next year will be even better. And there are, I think, clever off-market ways to approach the category versus buying spot assets. And also using structured notes is a clever way to approach it, right? The volatility of Bitcoin is so high that you should not be buying Bitcoin or ETH spot outright. You should be selling, for example, a cash secured put to lower the cost basis of your Bitcoin entry by using the premium for selling an option to enter the position. So I think all of that is going to be really interesting, and you're going to see more focus on that this year.
Yeah, and I guess just to kind of add my 2 cents there as well, I often think that crypto is a story of wealth effect. I think the past 3 or so Bitcoin native cycles have been driven into halving, and all of the innovation basically came after the wealth is created by them, by the run up in Bitcoin. And we had the ICO run up in 2017. We had the DeFi summer, gaming summer, NFT season, what have you. So I do think that the reason for that, the intuition that I have for that is, if we just have a hot ball of money, of crypto native money, we can't create more wealth. We need exogenous sources of capital, and usually the big flows of capital do not enter the space through Shiba or like Doge or even Solana. They enter the space through Bitcoin. So that's where kind of the wealth is created. So that's something that I'm still kind of waiting for, and I think that will be hard without an easier monetary environment. So I think this episode has been very helpful for our listeners understanding just what is happening on that side of the world, especially because I know a lot of our listeners are very crypto native folks and don't have as much insight into what's going on in the kind of broader markets world. So really, really appreciate for coming on for the show round. For people who want to reach out to you or follow your research or follow your Twitter threads, what are the best places for them to do this?
Yeah, follow me on Twitter at Ram Ahluwalia. You can also follow Lumida. It's Lumida. We publish research. You can subscribe to our research at our website, lumida.com, and also hang out on Twitter with us. We love the interaction. Thank you, Jason, for the great work you do as well.
Definitely. Thank you so much. All right, that's it for this week's episode of the Blockcrunch podcast. So thank you so much for tuning in. If you enjoyed this episode, please make sure to subscribe on your favorite apps. And in case you didn't know, this interview is also available as a video on YouTube. And if you tag the Blockcrunch on Twitter this week and tell us what you liked about this episode, I'll be sure to respond to you as well. Now, if you'd like to go even deeper, we have a VIP tier where every week or so, we write an in-depth research brief or investment memo on a project. And we'll have exclusive AMAs with myself where I answer all your questions as well. Now, we already have analysts from some of the top funds and companies in crypto as subscribers. So if you're serious about getting an edge in crypto, head on over to theblockcrunch.com/VIP to learn more. And once again, thanks for supporting the show, and I'll see you next week.